Usually when we talk about a financial diagnosis, there's this expectation of, like, absolute precision.
Right, yeah, like reading an X-ray.
Exactly. You look at a traditional company's balance sheet, and it really is like reading an X-ray.
Mm.
You see the revenue, the liabilities, the cash flow. It's like that jagged white line on the film where the bone is broken,
Right, the analyst just points and says, well, there's the problem. It's binary, it's visible.
categorized.
Yeah.
But then, you step into the world of digital assets, and suddenly you are trying to read that same X-ray in the dark.
And underwater.
Yeah, underwater, while the patient is, like, actively changing shape.
It is the absolute definition of diagnostic murky waters. I mean, we are dealing with an asset class that fundamentally rejects the traditional laws of financial physics.
Totally.
You go from the clear, predictable frameworks of legal jurisdictions and quarterly earnings reports to something entirely different. A landscape built purely on code, cryptography, and, well, human psychology.
Welcome to the Deep Dive, everyone. Today, we are looking at some incredibly dense financial architecture. This is data compiled specifically for serious financial analysts, and we're using it to answer one terrifying question.
What happens when the underlying value of your money is based entirely on human belief and computer code?
Right. Because for anyone trying to navigate the modern financial world, the crypto space often feels like this bizarre mix of high-tech wizardry and a 3 a.m. casino gambling floor.
Which is a very accurate description, honestly.
It really is.
Ah.
So our mission today is to extract the signal from the noise.
Yeah.
We are going to completely demystify what actually gives these digital lines of code value, how the underlying mechanics work, the truly spectacular ways they can fail, and what it all means for your own personal understanding of what money even is.
Because, the headlines you see every day, they just focus on the noise.
Right, the overnight billionaires.
Exactly. The billionaires or the catastrophic multi-billion-dollar bankruptcies. But the real story is found in the architecture of the technology itself and the unprecedented evolution of market psychology that we're witnessing in real time.
So we are essentially going to throw away that traditional X-ray machine and build a completely new diagnostic tool. And just as a quick note, as we dive into these sources, some of this touches on pretty heated debates in the financial world. We aren't here to take a side or endorse a specific ideology. We're just impartially unpacking what the source material tells us.
Just reading the data.
Exactly.
Okay.
So let's start with the fundamental philosophy of value, because I think this is where the biggest mental hurdle lies for people.
Oh, absolutely.
When you look at traditional financial assets, stocks, bonds, real estate, they are rooted in concrete realities. They have well-established, tested legal frameworks.
Right.
But more importantly, they represent a claim on expected cash flows. If you buy a bond, you get interest. If you buy a stock, you own a piece of a company generating profits. But digital assets.
The data is unequivocal here. They do not have an inherent value based on underlying cash flows. They have zero fundamental economic value in the traditional sense.
Zero.
Zero. That absence of cash flow is the defining characteristic of the entire space. I mean, when you evaluate a traditional equity, you can build a discounted cash flow model.
Right. You look at the macro environment.
Exactly. You project future earnings, discount them back to the present, and arrive at an intrinsic value. And if the market price falls significantly below that intrinsic value, you have a margin of safety.
But with digital assets like Bitcoin, there is no cash flow to discount.
None. There is no earnings report. Their legal and regulatory protection is ambiguous at best and completely non-existent at worst.
Okay, so let's unpack this with an analogy. Because if traditional investing is like buying an apple tree because you want to sell the apples, for the cash flow, buying a digital asset like Bitcoin is more like buying a rare baseball card.
That's a great way to look at it.
Right. The baseball card doesn't yield quarterly dividends. It doesn't actually do anything.
No, it just sits in a piece of plastic.
Yeah. But if everyone in the collecting community agrees that it's rare, and everyone agrees it's desirable, it becomes valuable. So the value is entirely subjective and driven by consensus.
And the drivers of that consensus are fascinating. We're looking at market adoption, perceived scarcity, network effects, and technological advancement.
Let's talk about that perceived scarcity for a second.
Okay, so take Bitcoin. It was launched in 2009 to secure payments in a peer-to-peer network designed as an alternative to traditional fiat currencies.
Right.
But its fundamental architecture includes a hard cap. There will only ever be 21 million Bitcoins in existence.
Period.
Period. That self-imposed limit creates an artificial cryptographic scarcity. If demand goes up and supply is strictly limited by immutable code, the price must go up.
But hold on, anyone can copy open source code, right? I mean, I could create Hostcoin tomorrow, cap it at 21 million, and it would be just as scarce as Bitcoin,
You absolutely could.
but it wouldn't be worth anything. So
Yeah.
scarcity alone isn't enough.
Which is exactly where network effects come into play. Bitcoin was the first mover. It established a massive decentralized network of users, developers, and the miners who secure the network with computational power.
So it's about the ecosystem around it.
Precisely. In a market driven by adoption rather than cash flow, that network effect is an incredibly deep, nearly impenetrable moat. As of mid-2022, just two coins, Bitcoin and Ether, made up over 80% of the total cryptocurrency market value.
Wow, over 80%.
Yeah. There are thousands of alternative coins, but the ecosystem is remarkably top-heavy because liquidity begets liquidity, and trust begets trust.
Right. So for you listening, why should you care about this difference? Because if you try to analyze a cryptocurrency the same way you analyze a blue chip stock, you are going to get slaughtered.
Absolutely slaughtered.
You can't look for a PE ratio. You have to understand market psychology, technological adoption curves, and sentiment.
Because these assets don't have underlying cash flows to anchor their value, their prices reflect nothing but market expectations at the exact moment a transaction takes place.
Right. It's just pure price discovery.
Pure price discovery. Without a fundamental anchor, the asset is entirely at the mercy of shifting narratives. A regulatory rumor in one country or a tweet from a prominent billionaire can alter the consensus reality instantly.
Which leads to the insane volatility we see in the charts.
Exactly.
Okay, so if Bitcoin is the rare baseball card, sitting in a protective case deriving value from its scarcity and network effect, what happens when you make that card smart?
Ah, right.
Because Bitcoin, fundamentally, is just a calculator. It securely records that person A sent X amount of Bitcoin to person B.
It's a distributed ledger, yes. Highly secure, but functionally limited by design. And that limitation is what led to the development of alternative coins, or altcoins.
Like Ether.
Right, the most significant of which is Ether, running on the Ethereum network launched in 2015. Ethereum fundamentally changed the paradigm. If Bitcoin is a pocket calculator, Ethereum is a global, decentralized supercomputer.
A supercomputer.
Yeah, it introduced the concept of the Turing-complete smart contract.
Okay, we all know the term smart contract, but let's really look at the actual implications here. Because we aren't just talking about a digital if-then statement. We're talking about irreversible, immutable execution of logic without any human intervention.
Or legal arbitration, yes, exactly.
Right.
A smart contract is a self-executing agreement where the terms are written directly into lines of code deployed on the blockchain. Once triggered by a predefined condition, it runs automatically.
So there's no middleman.
No middleman, no escrow agent, no court of law. I mean, think of flight insurance. If Flight 123 is delayed by 2 hours, a decentralized oracle feeds that data to the smart contract, and the contract automatically pays out the policy to the passenger's wallet.
Instantly.
Instantly. The execution provides a trackable, irreversible record verified by thousands of independent nodes.
But, okay, let me play devil's advocate here for a second. In traditional finance, if my bank makes an error, or, if I get defrauded, there's a mechanism for reversal.
Sure, you call the bank.
Right, I call the fraud department. They investigate, and they reverse the charge. The system relies on centralized human judgment as a failsafe. If a smart contract has a bug in its code, and we know all code has bugs, and an exploiter drains millions of dollars, the blockchain just views that as a valid transaction, right?
It executed the code exactly as written.
That is terrifying.
You've hit on the core tension of programmable money. The blockchain doesn't care about intent. It only cares about execution. Code is law is the rallying cry of the purists, but when the code is flawed, the law is unforgiving.
Right.
That immutability is a double-edged sword. It guarantees execution without counterparty risk, but it replaces counterparty risk with systemic code risk.
Which brings us to the holy grail and, frankly, what seems like the most dangerous experiment in the entire crypto space, stablecoins.
Ah, yes.
Because developers realize pretty quickly that cryptocurrencies are terrible mediums of exchange because of that massive volatility we talked about.
Mm-hmm.
I mean, you can't run a business, pay employees, or buy goods with a currency that fluctuates 10% a day.
It's impossible. So they created stablecoins designed to maintain a one-to-one peg with a real-world asset, typically the US dollar.
And we really need to dissect the two distinct methodologies developers use to achieve this stability. Because from the source material, the difference between them is literally the difference between relative safety An absolute catastrophe.
It really is. So the first type is the securitized stablecoin. Tether and USD Coin are the prime examples here. These operate somewhat like a traditional money market fund.
Okay.
The issuer claims that for every digital token circulating on the blockchain, there is a corresponding US dollar or a highly liquid equivalent, like short-term treasuries, sitting in a regulated bank account.
So the mechanism relies on traditional physical collateral. If I hold 1 million Tether tokens, theoretically the issuer has 1 million real dollars in a vault somewhere.
Right, and if the market price of Tether drops to, say, 99 cents on an exchange, arbitrageurs will jump in. They buy it up at 99 cents and redeem it with the issuer for the underlying dollar.
Making a risk-free 1 cent profit.
Yeah, exactly.
Yeah.
Which pushes the price back to $1. Assuming the reserves are fully backed and highly liquid, the securitized model works. The risk there is essentially traditional audit risk.
Like, do they actually have the money they say they have?
Precisely. But the crypto ecosystem is fundamentally opposed to relying on traditional banks and physical vaults. They view that as centralization, a central point of failure. So they engineered a completely different beast, the algorithmic stablecoin.
And this is where financial engineering crosses the line into pure hubris. Because algorithmic stablecoins have no dollars in a bank, no physical collateral backing them.
None.
Their value is maintained purely by software that mints or destroys tokens based on demand to keep the price pegged to exactly $1.
And the most spectacular failure of this model, and honestly one of the most devastating wealth destruction abuse in modern financial history, was the collapse of Terra and its sister coin, Luna, in May 2022.
Oh man, yeah. The architecture of this system is just a masterclass in flawed incentive structures. Walk me through the exact mechanics of the Terra Luna ecosystem. Because calling it an algorithm makes it sound like an infallible machine, but it was really just a set of economic incentives built on blind faith.
Right. Okay. So the issuer created Terra USD, the stable coin, which was meant to always equal $1. To absorb the volatility, they created a separate floating governance token called Luna.
Okay, so 2 coins.
2 coins. The algorithm linked them with an ironclad programmatic rule. You could always exchange 1 Terra USD for exactly $1 worth of newly minted Luna and vice versa.
Okay, so let's walk through the arbitrage loop when it's functioning correctly. Let's say there's a slight market panic, people sell Terra, and the price drops to 98 cents on an exchange.
An arbitrage trader spots that discrepancy. They buy the Terra USD on the open market for 98 cents. They immediately use the blockchain protocol to burn or destroy that Terra USD. And in exchange, the algorithm mints them exactly $1 worth of Luna tokens at the current market price of Luna. The trader then sells that Luna on the open market for $1.
Boom. They just made a 2-cent risk-free profit per token.
Exactly. But more importantly, by burning the Terra USD, they reduced its circulating supply. Economics 101 dictates that reducing supply against constant demand raises the price.
So the price of Terra drifts back up to $1.
Right. It's an elegant, self-correcting machine powered entirely by the greed of arbitrageurs.
And here's where I have to push back. I'm looking at this mechanism, and there is a glaring, fatal assumption baked into the foundation. The entire system only works if the market believes Luna has value.
Yep.
You're trading a supposedly stable asset for a highly volatile asset. What happens if the market stops wanting Luna?
That is the exact vulnerability that triggered the collapse. The system works flawlessly right up until a crisis of confidence occurs. It's akin to a country defending a currency peg by printing infinite amounts of its own domestic currency to buy back the pegged currency.
Right, if the market realizes the domestic currency is becoming worthless through hyperinflation, the defense collapses.
Exactly. And on May 9, 2022, we saw a bank run executed by software at the speed of light. The price of Luna began to slide due to broader market pressures. People got nervous about the Terra peg holding, so they rushed to redeem their Terra for Luna exactly as the algorithm allowed.
But because the price of Luna was simultaneously dropping, the algorithm had to print more and more Luna coins to equal that $1 value for every Terra redeemed.
Right. If Luna is worth $100, redeeming 1 Terra mints 0.01 Luna. If Luna crashes to $1, redeeming 1 Terra mints 1 full Luna.
And if Luna crashes to a penny, redeeming 1 Terra mints 100 Luna.
Exactly. The algorithm initiated a hyperinflationary death spiral. As people desperately hit the redeem button to escape Terra, the supply of Luna literally exploded. In just one single week, the supply of Luna skyrocketed from 350 million coins to 6.5 trillion coins.
Trillion, with a T.
With a T. The massive influx of new Luna tokens crashing onto the market crushed the price of Luna to fractions of a penny. The arbitrageurs realized that the Luna they were receiving was losing value faster than they could sell it.
So they stopped stepping in.
They stopped. The mechanism broke down entirely. Terra completely depegged from the dollar, falling to pennies, and tens of billions of dollars in wealth vanished almost overnight.
It's just staggering. What fascinates me is the systemic contagion of it all.
Yeah.
This wasn't just isolated to the people holding Terra. The collapse sparked massive panic across the entire crypto ecosystem. People started demanding redemptions on the securitized stablecoins like Tether because trust, which is the only actual currency that matters in finance, had been fundamentally shattered.
A bank run is a bank run. Whether it happens outside a brick-and-mortar institution in 1929 or across distributed ledgers in 2022, when algorithmic pegs fail, they expose the harsh reality that building a system reliant entirely on subjective endogenous value, a token backing a token, is building a house of cards.
Yeah.
When it breaks, there is no Federal Reserve to step in as a lender of last resort. There is no FDIC insurance to make retail depositors whole. There is just an algorithm relentlessly doing its job, printing trillions of worthless tokens until this system flatlines.
So for you listening, understand that stable is just a marketing term. The difference between a securitized coin and an algorithmic one is literally the difference between safety and total ruin.
Absolutely.
But okay, so algorithmic pegs failed because they relied on the subjective value of a sister token. But if you think a multi-billion-dollar ecosystem built on subjective value is wild, wait until you see what happens when that subjective value is literally driven by an internet joke about a Shiba Inu.
Oh boy, meme coins.
Let's look at meme coins and, more importantly, the market microstructure that allows them to be so heavily manipulated. Because this is wild.
Meme coins represent the most surreal and cynical aspect of the digital asset landscape. I mean, they are cryptocurrencies often inspired by an internet joke, launched generally for entertainment purposes, with zero pretense of utility or technological innovation.
Dogecoin is the undisputed king here, right?
Right. Founded in 2013, and the creators explicitly stated it was a mockery of the cryptocurrency craze. They intentionally designed the code so that there would be an infinite supply, emitting billions of new coins constantly. It was a direct parody of the engineered scarcity that gave Bitcoin its value.
So they engineered it to be fundamentally worthless.
Yes. But they severely underestimated the power of internet culture combined with speculative mania. Driven by social media endorsements from extremely high-profile business figures, the joke stopped being a joke.
Retail investors, seeing the price move a fraction of a cent, started piling in, driven by the fear of missing out. FOMO.
FOMO, exactly. And at its peak in May 2021, Dogecoin's market capitalization hit over $80 billion US.
That is just, that is larger than the market cap of many legacy blue-chip corporations that employ tens of thousands of people, build actual physical infrastructure, and generate billions in audited revenue.
It's a testament to the fact that in a zero-interest rate environment, liquidity will chase any narrative, no matter how absurd.
But gravity always wins.
It always does. When the macroeconomic environment shifted and liquidity dried up, speculators began dumping these coins. By May 2022, the market cap had plummeted to $11 billion, a devastating loss for retail investors who bought the top.
But the real danger of meme coins isn't just the sheer absurdity of their valuation, is it? It's the market manipulation happening beneath the surface in a completely unregulated space. We really need to look closely at market concentration and liquidity depth here.
Right. The data on Shiba Inu, or SIB, which is another dog-themed meme coin, is staggering. We need to look at the concentration of wealth, specifically the community jargon known as whales.
We all know whales can manipulate illiquid markets in traditional finance, but the Gini coefficient, the measure of wealth inequality in these tokens, is astonishing.
According to blockchain analytics platforms tracking EIB, in August 2022, 41% of all SHAB had been burned.
Okay, meaning?
Burning means the tokens are sent to a verifiable dead wallet address where no one holds the private keys. They are permanently removed from circulation to artificially restrict supply.
So 41% of the float is gone forever. But what about the remaining active supply?
Of the circulating coins that remain, the top 10 wallets were estimated to hold roughly 36% to 39% of the total supply.
Wait, 10 entities controlling nearly 40% of the money supply?
Yes.
That completely shatters the utopian dream of a democratized, decentralized financial revolution. If 10 anonymous wallets control 40% of the market, that's not decentralization. That's just an oligopoly waiting to dump on retail investors wearing a dog mask.
And that oligopoly has immense unchecked power because of how thinly traded these assets actually are. The average daily trading volume for SCM was less than 10% of the total tokens.
Okay, let's break down why that low volume is so critical for the listener. If a market is thinly traded, it lacks liquidity depth on the order books.
Exactly. Imagine a swimming pool. If the pool is deep, meaning high liquidity, a whale can jump in and out, and the water level barely changes.
Right.
But if the pool is shallow, low liquidity, a whale jumping in causes a massive splash, and jumping out drains the pool entirely.
So in a thinly traded market, if just one of those top 10 holders decides to sell even a fraction of their position, their sell order instantly consumes all the available buy orders on the exchange.
Yes, the price experiences massive slippage and crashes violently. And conversely, if a whale buys a little more, they sweep the order book and the price spikes artificially.
Which triggers retail investors to FOMO buy into the artificial momentum.
Exactly. This environment allows large holders to wash, trade, and manipulate the price action with impunity because they are playing in an unregulated arena.
You aren't investing. You are playing a poker game where a few players can see the entire deck and change the rules mid-hand. So if you're tempted by the hype of a coin going to the moon, remember you are swimming in a pool controlled by a few massive players who can drain the water at any moment.
Precisely. Which forces us to ask, if the assets themselves are this volatile, subjective, and prone to extreme manipulation, how are average retail investors actually interacting with them? Where does this trading take place, and how is the plumbing of this ecosystem structured?
This brings us to the paradox of centralization and the spectacular, catastrophic fall of FTX. Because the infrastructure of how people buy and hold digital assets is basically split into three main avenues, right? Direct investment, decentralized exchanges, or DigEx, and centralized exchanges, CEXs.
Right. So direct investment is the purest form of crypto participation. You interact directly with the blockchain protocol using a non-custodial digital wallet. You hold the cryptographic public and private keys. You alone are responsible for the security of your assets.
But the average retail investor doesn't want to manage complex cryptographic passkeys, worry about cold storage, or deal with complicated user interfaces. I mean, they want an experience that mimics traditional brokerage apps. They want to link their bank account, click buy, and see a number go up on their screen.
Exactly, and that consumer demand created the centralized exchange. These are privately held corporations that act as intermediaries. They aggregate buyers and sellers, provide an easy-to-use matching engine, and crucially, they hold custody of the assets on behalf of the users.
But the ideological contradiction here is massive. I mean, Bitcoin was explicitly invented by Satoshi Nakamoto to eliminate the need for a trusted third party, right? To remove this central point of failure that traditional banks represent.
Right.
Yet to access this decentralized revolution, millions of people handed their assets right back to opaque, unregulated third parties.
It's incredible. Centralized exchanges consolidate all the assets into their own massive institutional wallets, keeping an internal database of which user owns what. This creates massive honeypots for hackers. If the exchange's central server is compromised or if an insider goes rogue, the assets are gone.
So what's the alternative? The crypto-native alternative is the decentralized exchange, or DEX.
Right. A DEX attempts to solve the honeypot problem by utilizing smart contracts. There is no central server, no corporate headquarters, no order book managed by a company. Users trade directly with one another, peer-to-peer, usually through a mechanism called an automated market maker, or AMM.
The code itself facilitates the swap.
Exactly. Because it is distributed across thousands of nodes, attacking a DEX directly is mathematically improbable.
But the trade-off for that mathematical security is a complete lack of regulatory oversight. Because there is no central entity running the DEX, there are no know your customer or anti-money laundering checks. Anyone, anywhere can list any token and trade anonymously. It is the absolute Wild West for fraudsters.
So investors face a grim choice: the technical complexity and fraud risk of the decentralized frontier, or the convenience of a centralized exchange that demands absolute trust in its operators.
And the danger of extending that trust was laid bare by the collapse of FTX in November 2022. This is the poster child for what happens when complex financial engineering meets an absolute vacuum of regulatory oversight and risk management. This wasn't just a hack. This was a fundamental structural rot. Let's dissect how this unfolded, because the timeline is stunning.
It really is. FTX was a Bahamas-based cryptocurrency exchange founded in 2019 by Sam Bankman-Fried. It grew at an astonishing rate, offering spot trading, complex derivatives, and custodial services. By early 2022, it was valued at $31.6 billion.
It cultivated this aura of extreme legitimacy. They were backed by elite venture capital firms, plastering their logo on sports arenas and presenting themselves as the adult in the room of the crypto industry.
But beneath that veneer of legitimacy was a massive conflict of interest and a fatal structural flaw. We have to talk about Alameda Research and the creation of the FTT token because this is the linchpin of the entire disaster.
Let's do it. What was Alameda?
Alameda Research was a quantitative trading firm, essentially a crypto hedge fund, deeply intertwined with FTX and entirely controlled by Bankman-Fried. And like many centralized exchanges, FTX created its own proprietary cryptocurrency, a utility token called FTT.
Okay, let's break down the mechanics of an exchange token for a second.
Right.
Because it's not equity in the company, doesn't pay dividend. What does it actually do?
FTT was designed to offer users discounts on trading fees on the FTX platform. But more importantly, FTX allowed users to post FTT as collateral to borrow against for margin trading.
Wait, so its value was entirely subjective, dependent on the perceived health and popularity of the FTX exchange itself?
Yes. It's essentially a casino printing its own poker chips out of thin air and then telling the players they can use those chips as collateral to borrow real cash from the cage.
And here is where the financial engineering gets truly toxic. FTX minted hundreds of millions of these FTT tokens, but they kept the vast majority of the supply locked up, releasing only a tiny fraction to trade on the open market.
That is crucial. By restricting the circulating supply, it took very little buying pressure to push the price of the FTT token up to $25 or more.
Okay, I see where this is going. Once that token is a publicly traded price of $25, the founders look at the millions of tokens they kept locked in their own treasury and say, wow, we have billions of dollars of assets on our balance sheet.
Exactly. But it's phantom wealth. It's marked to market at the price of a highly illiquid, thinly traded asset.
And that is exactly what Alameda Research did.
Yes. On November 2nd, 2022, a cryptocurrency news outlet called CoinDesk published a leaked copy of Alameda's balance sheet. It revealed that Alameda had $14.6 billion in assets, but an absolutely staggering portion of those assets were comprised of FTT tokens or other highly illiquid tokens connected to the FTX ecosystem.
Okay, I want to make sure the mechanics of this are crystal clear for you listening. The founder creates an exchange. The exchange invents a token out of thin air. The founder's private trading firm puts billions of dollars of this invented illiquid token on its balance sheet.
Right.
The trading firm then goes out and uses that FTT token as collateral to borrow real assets like Bitcoin, stablecoins, and customer fiat deposits.
It was a massive rehypothecation scheme built on a highly centralized, completely illiquid asset. Alameda was functionally insolvent, borrowing against magic beans.
Wow.
When the CoinDesk article hit, the broader market, and specifically the CEO of rival exchange Binance, realized that Alameda's solvency depended entirely on the price of FTT holding steady.
And the CEO of Binance publicly announced he was going to sell his massive holdings of FTT. It was the spark in the powder keg.
It triggered an immediate, devastating bank run. Investors rushed to sell FTT, crashing the price from $25 to $1 in a matter of days.
And as the value of Alameda's collateral evaporated, it became terrifyingly clear that FTX had been lending customer deposits to Alameda to cover its trading losses.
Customers scrambled to withdraw their actual funds from the FTX exchange, but the funds weren't there. FTX simply did not have the liquid assets to meet the withdrawal demands because they had been funneled to Alameda and vaporized in bad trades.
On November 11th, 2022, FTX filed for bankruptcy. The filings revealed a $9 billion hole. They had $9 billion in liabilities against a mere $900 million in liquid assets.
Over 100,000 creditors were left stranded. The collapse erased billions in customer funds and sent shockwaves through the industry, bankrupting several prominent crypto lending firms that had exposure to FTX.
The ultimate lesson here is the golden rule of crypto. Not your keys, not your coins. If your assets are sitting on a centralized exchange, you do not actually own them. You hold an IOU. You are an unsecured creditor to an unregulated entity holding a database entry with your name on it.
And if they go bankrupt, or if they decide to commingle your funds with a reckless hedge fund, You are completely wiped out.
which naturally pushes investors back toward direct investment, holding their own private keys.
Mm-hmm.
But as we established earlier, fleeing the centralized exchange just walks you into a different set of severe risks.
Oh, absolutely. If you hold your own keys, you are solely responsible for navigating an ecosystem riddled with smart contract exploits, phishing schemes, and classic confidence games.
Let's talk about the rampant fraud facing direct investors, specifically pump and dump schemes and the evolution of the Ponzi scheme. Because the technology might be new, but human greed is ancient. The mechanics of a pump and dump in the social media age are just devastatingly effective.
A classic example is Ethereum X, or EMAX, from May 2021. The anatomy is simple. Insiders create an obscure asset, hoard the supply, and then generate massive artificial hype. With Emacs, the orchestrators didn't just rely on anonymous message boards, they weaponized celebrity culture.
Right, they paid A-list pop stars, reality TV figures, and famous athletes to aggressively promote the token to their millions of social media followers.
They touted it as a culture coin. And despite having Ethereum in the name, it had absolutely no technical connection to the actual Ethereum network. It was just an ERC20 token built to ride the hype. The celebrities created an illusion of legitimacy and massive FOMO among retail investors.
And the frenzied buying from retail investors pumped the price up sharply. But once the price reached a profitable threshold, the insiders executed the dump. They systematically sold off their massive holdings into the liquidity provided by the incoming retail buyers.
And the moment the insiders stop promoting it and start selling, the buying support vanishes entirely. The price collapses. Within a month, Emacs had lost almost all its value.
The retail investors who bought the top were left holding worthless digital tokens, while the insiders walked away with millions. It's a textbook transfer of wealth from the uninformed to the orchestrators.
And it's not just pump and dumps. It's sophisticated Ponzi schemes wrapped in dense technological jargon. Take the case of Forsage, launched in January 2020.
Okay, so a traditional Ponzi scheme pays existing investors with funds collected from new investors rather than from actual profit earned. It requires a constant influx of new capital to survive. How did Forsage spin this?
They wrapped this classic scam in buzzwords. They marketed themselves as a decentralized blockchain platform enabling smart contracts on various networks. But underneath the jargon, the SEC alleged it was a massive pyramid and Ponzi scheme.
So the smart contracts weren't actually generating yield.
No, they were simply routing incoming capital from new recruits directly to the wallets of earlier investors and the founders.
And they managed to raise over $300 million from retail investors worldwide before the regulatory hammer fell. $300 million routed through immutable code.
This highlights a profound and terrifying irony about blockchain technology. The underlying cryptographic architecture rarely fails. The distributed ledger validates asset transfers flawlessly.
Exactly. The blockchain flawlessly executed the transfer of funds from the victims to the scammers in the Forsage case. It flawlessly recorded the Emacs insiders dumping on retail investors. The code works perfectly. The failure point is entirely human. It's like we've built an incredibly secure, indestructible titanium vault. The cryptographic locks are impenetrable. But we keep voluntarily handing the combination to a con artist we met on Twitter because they promised us a guaranteed 20% weekly return.
Or even more tragically, we just accidentally lose the combination.
Okay.
Because direct ownership means absolute self-custody. Human error is catastrophic. If you forget your password to your banking app, you click Forgot Password and reset it via email.
Right.
If you lose the unique 24-word cryptographic seed phrase to your hardware wallet, the holdings are irretrievable. There's no customer service desk on the blockchain.
The statistics on this from the sources are haunting. It's estimated that around 20% of all mined Bitcoins are sitting in lost or deserted wallets that their owners can no longer access. 20%.
We are talking about tens of billions of dollars of wealth permanently locked away behind forgotten passwords or stored on hard drives that were accidentally thrown into landfills. It is a deflationary black hole created purely by human forgetfulness.
So when institutional investors, portfolio managers, or even cautious retail investors look at this landscape, the algorithmic death spirals of Terra, the thinly traded manipulation of meme coins, the catastrophic fraud of centralized exchanges like FTX, the smart contract vulnerabilities, and the absolute finality of losing a private key, they realize the infrastructure is too hostile for traditional capital allocation.
Exactly. There has to be a safer way to gain exposure to the price action of this asset class without dealing with the radioactive plumbing of the crypto ecosystem. And that brings us to the financialization of digital assets. The suits move in.
Right, because the traditional financial industry spent years building regulated wrappers around cryptocurrencies.
These indirect investment forms allow investors to gain exposure to the price movements of cryptocurrencies without ever having to download a digital wallet, manage a private key, or worry about an unregulated exchange going bankrupt. They utilize the existing rails of traditional finance.
Okay, let's break down the vehicles here for the listener. The earliest methods were cryptocurrency coin trusts. These operate structurally like closed-end funds, right?
Right. A trust buys a massive pool of a specific cryptocurrency, secures it with institutional-grade cold storage custody, and then issues shares of the trust that trade over the counter, or OTC.
The major benefit being that the trust handles the complex custody and security, providing a layer of transparency.
Yes, but there are significant drawbacks. Because it's an OTC-traded trust, not a standard ETF, the shares can deviate wildly from the underlying net asset value, or NAV, of the crypto they hold. Depending on market demand and the structure of the trust, you could be paying a massive premium, say buying $1 worth of Bitcoin for $1.40, or selling at a steep discount. Furthermore, these trusts historically charged exorbitant management fees, often in excess of 2% annually.
Wow. Then you have cryptocurrency futures contracts trading on regulated traditional exchanges like the Chicago Mercantile Exchange. Let's talk about those.
A futures contract is a standardized agreement to buy or sell a specific quantity of an asset at a set price on a specified future date. But crucially, these crypto futures are typically cash settled. If you buy a Bitcoin futures contract, no actual Bitcoin ever changes hands when the contract expires. The profit or loss is settled in US dollars.
So it allows institutional traders to bet on the price movement or hedge their exposure without ever touching the actual blockchain.
Exactly, but trading futures introduces a massive new risk leverage.
Right.
Futures trading requires only a fraction of the contract's total value as an initial margin deposit. This leverage magnifies potential gains, but it equally magnifies potential losses. In an asset class as inherently volatile as cryptocurrency, a heavily leveraged futures position can result in rapid margin calls and complete liquidation of your capital.
So the evolution of these indirect vehicles inevitably led to the holy grail of retail access, the Cryptocurrency Exchange Traded Fund, or ETF. ETFs are the ultimate convenience wrapper. You buy and sell them through your standard Fidelity or Schwab brokerage account, just like you would buy a share of Apple or an S&P 500 index fund.
Right, but early iterations of crypto ETFs didn't actually hold the cryptocurrency directly. They held portfolios of those cash-settled futures contracts. This created a drag on performance due to the costs of constantly rolling over expiring futures contracts, a phenomenon known as contango.
But the regulatory landscape is shifting to allow spot ETFs, which actually hold the underlying asset.
Yes, and regardless of the structure, ETFs offer a highly regulated, highly liquid, tax-advantaged way to gain exposure, protected by standard brokerage insurance like SIPC against the failure of the brokerage firm itself.
So if you're intrigued by crypto but terrified of losing a password or getting hacked, you're paying an annual expense ratio for the convenience, but you're completely insulated from the risk of a smart contract hack or a lost hard drive.
Exactly. And beyond funds, investors can seek proxy exposure through cryptocurrency stocks.
Like buying equity in publicly traded mining companies.
Or semiconductor manufacturers that build the specialized mining hardware. Or payment processors that facilitate crypto transactions. Finally, for high net worth individuals and institutions, there are specialized crypto hedge funds. These funds utilize traditional quantitative strategies, arbitrage, and long-short positioning to generate alpha in the digital asset space, often employing complex on-chain strategies that are far too technical for the average investor to execute.
The integration of crypto into traditional finance is a massive paradigm shift. But it's not a one-way street, is it? Wall Street is wrapping crypto in traditional structures, but crypto developers are aggressively attempting to pull traditional finance onto the blockchain.
This is the promise of tokenizing the world and decentralized finance, or DeFi. If the first half of the digital asset revolution was about creating money out of thin air, the current frontier is about anchoring blockchain technology back to the physical world through asset-backed tokens.
Okay, so the concept is that any physical or financial asset, gold, crude oil, real estate, carbon credits, or traditional equities, can be represented by a cryptographic token on a blockchain.
Exactly.
But why? I mean, if I want to invest in real estate, I can buy a real estate investment trust, a REIT. If I want gold, I buy a gold ETF. Why go through the complex process of creating a digital token representing a physical bar of gold sitting in a vault?
The advocates point to three major transformative benefits here. First, the blockchain serves as an immutable, cryptographically secure registry of ownership. It theoretically streamlines the incredibly complex and expensive back-end plumbing of traditional finance, reducing the need for clearinghouses, title companies, and settlement intermediaries.
Makes sense. What's the second benefit?
The second benefit is the big one, fractional ownership. Tokenization allows a highly illiquid, high-priced asset, say a $100 million commercial skyscraper in Manhattan, or a rare piece of fine art, to be broken down into millions of indivisible digital tokens.
Oh, wow. So it democratizes access.
Exactly. It allows a retail investor to buy 1,000th of a commercial property instantly on their phone and easily trade that fraction on a secondary market. It brings massive liquidity to markets that historically required millions of dollars in upfront capital.
And because these tokens are built on smart contract platforms like Ethereum, they can plug directly into the broader ecosystem of decentralized finance, or DeFi. So DeFi is an attempt to rebuild the entire architecture of global finance, lending, borrowing, trading, derivatives as a series of decentralized applications, or DApps, operating without any central coordinating entity.
Right. Instead of a bank taking your deposit and lending it out for a profit, a DeFi protocol uses an automated market maker and liquidity pools. You deposit your asset into a smart contract, the smart contract lends it to a borrower who posts collateral, and the algorithm automatically distributes the interest directly back to you, cutting out the corporate intermediary entirely.
So they envision a financial system that is permissionless, open 2047, and operates across borders instantly. That is the utopian pitch. But based on everything we've discussed today, I have to challenge that vision. The sources mention that DeFi advocates claim it reduces settlement time and eliminates counterparty risk. But look at the wreckage. The $300 million Forsage smart contract Ponzi, the multi-billion-dollar algorithmic collapse of Terra, the constant stream of protocol hacks where millions are drained because of a single flaw in the open source code. Has DeFi actually reduced risk, or has it simply replaced centralized bank risk with decentralized code risk?
That is the trillion-dollar question regulators are currently grappling with. You are essentially trading the risk that a bank executive commits fraud for the risk that a 22-year-old developer left a re-entrancy vulnerability in the smart contract code.
And history demonstrates that code is rarely perfect.
Never perfect. Even the most ardent advocates admit the space is nascent. The vast majority of DeFi activity currently isn't about streamlining global commerce. It's being utilized by traders to secure massive over-collateralized loans to make highly leveraged speculative bets on other volatile digital assets.
It is essentially a casino built on a decentralized supercomputer. So, considering all this, the staggering volatility, the existential risks of both centralized fraud and decentralized hacks, and the slow, complex integration with Wall Street, how does a rational financial analyst actually fit digital assets into a traditional investment portfolio?
We have to look at the ultimate scorecard: risk, return, and diversification. The historical performance data forces traditional portfolio managers to pay attention, despite the risks. If we look at Bitcoin as the benchmark, the long-term price appreciation is unprecedented.
Unprecedented.
From mid-2010, when it first traded publicly for mere pennies, it experienced massive parabolic bull runs followed by crushing multi-year bear markets, eventually peaking near $69,000 in late 2021.
The returns are just staggering. I mean, the data comparing monthly log returns from 2011 to 2022 shows Bitcoin averaging an 8.84% monthly return. Compare that to the S&P 500 total return at roughly 1.13% per month, or the global aggregate bond index at a fraction of a percent.
But return without risk context is meaningless. We measure that risk as standard deviation, the volatility of those returns. Over that same period, the standard deviation for Bitcoin's monthly returns was 0.32. The S&P 500 was 0.04.
So Bitcoin was historically 8 times more volatile than the broad U.S. stock market. The distribution of returns is wildly skewed. You have months of explosive, life-changing upside, immediately followed by 70% or 80% drawdowns that wipe out years of wealth. It is the definition of highly speculative, maximum risk alternative asset.
However, despite that extreme standard deviation, institutional capital began allocating to it for one very specific mathematical reason: modern portfolio theory and the search for uncorrelated assets.
Let's talk about correlation for a second. This is the holy grail for asset managers. Correlation measures how closely two assets move in relation to each other. A correlation of 1 means they move perfectly in sync. A correlation of zero means their price movements are completely independent.
Historically, cryptocurrencies exhibited incredibly low correlations with traditional asset classes. The historical data shows Bitcoin's correlation with the S&P 500 was only 0.21, and with global bonds, it was just 0.14. If you add a highly volatile, high-return asset to a traditional portfolio, and that asset does not crash when the stock market crashes, it actually lowers the overall risk profile of the portfolio while boosting expected returns.
And the reason for that low correlation was that crypto lived in an isolated ecosystem. Its price action was driven by idiosyncratic factors, a new protocol upgrade, a regulatory crackdown in Asia, or a massive hack. It wasn't reacting to the Federal Reserve raising interest rates or non-farm payroll data.
But the data is showing a massive structural paradigm shift. As we discussed earlier, the suits moved in. The creation of futures, ETFs, and massive institutional adoption means that macro-driven capital is now dictating the crypto markets. The correlation of cryptocurrencies with traditional equity markets is actively increasing.
Which presents a profound paradox for the asset class. Because the great irony here is that the more accessible, regulated, and mainstream crypto gets, the less useful it becomes as a unique, uncorrelated portfolio diversifier. When multi-billion-dollar hedge funds are trading Bitcoin ETFs algorithmically based on CPI inflation data and central bank policy, Bitcoin stops acting like a sovereign, uncorrelated digital gold and starts behaving exactly like a high-beta, risk-on technology stock.
Precisely. The mainstreaming of the asset class is eroding the very mathematical characteristic that made it so attractive to institutional portfolio managers in the first place.
Yeah.
The diversification benefits are no longer guaranteed.
Wow. We have covered an immense amount of ground today. We started by discarding the traditional tools of financial analysis, recognizing that we are dealing with assets driven not by cash flows, but by perceived scarcity, network effects, and human belief.
We watched the utopian dream of programmable money curdle into the algorithmic nightmare of the Terra Luna hyperinflationary death spiral.
Yeah. And we examined the extreme market microstructure of meme coins, where thinly traded liquidity pools allow a handful of whales to manipulate multi-billion-dollar valuations built on internet jokes. We dissected the fatal arrogance of centralized trust, watching FTX use phantom exchange tokens to collateralize billions in fraudulent loans.
And we confronted the persistent, unavoidable human elements of social engineering and lost keys that plague direct ownership.
We explored how traditional finance is building safer, highly regulated plumbing around these volatile assets, while developers attempt to tokenize real-world assets and rebuild global finance through decentralized protocols. And finally, we saw how the math of diversification is shifting as Wall Street swallows the ecosystem.
In a landscape evolving this rapidly, where the technological frontiers outpace the regulatory frameworks by years, critical thinking is your only real protection. Understanding the underlying mechanics, knowing the difference between a securitized collateral reserve and an algorithmic loop, understanding the liquidity depth of an order book, and recognizing the trade-offs between centralized counterparty risk and decentralized smart contract risk is how you survive the volatility.
That deep mechanical understanding is your best defense against both missing out and losing it all. It is the signal hidden in the noise. But before we wrap up this deep dive, we want to leave you, the listener, with a final lingering thought to explore on your own. It built on everything we've unpacked today regarding the institutionalization of this space.
Consider the foundational genesis of this technology. Bitcoin was explicitly invented in the shadow of the 2008 financial crisis as a rejection of the traditional banking system. Its entire appeal was its resistance to censorship, its peer-to-peer nature, and its absolute immunity to centralized institutional control.
Right. So what happens to the soul of cryptocurrency when it is fully assimilated? When the vast majority of Bitcoin isn't held in private, non-custodial wallets by individuals, but is instead held in massive ETFs managed by Wall Street, traded by high-frequency algorithms based on Federal Reserve macro data, and custodied by the very legacy banks that the blockchain was invented to destroy. Does it still represent a decentralized financial revolution? Or has the revolution simply been tamed, packaged, and transformed into just another heavily regulated, correlated ticker symbol flashing red and green on a screen?
It is the ultimate paradox of adoption. To achieve mainstream legitimacy and global scale, the technology had to embrace the exact centralized financial structures it was designed to destroy.
The diagnostic waters of finance have never been murkier. But hopefully, after this exploration of the mechanics, you have a much better framework to help you navigate them. Thanks for joining us.